For years, Europe counted heavily on Russia to keep the lights on and homes warm. Before 2022, about 40% of the natural gas the European Union used came straight from Russia. Countries like Germany leaned in even harder, with over half of its gas, around 55%, coming from Russian pipelines. Why such heavy reliance? Simple. Russia offered plenty of gas at prices that made economic sense, and for a long time, it seemed like a steady, reliable deal. But everything changed in 2022 when Russia launched a full-scale invasion of Ukraine. The war sent shockwaves through Europe, forcing leaders to rethink their energy game plan. Supporting Ukraine meant cutting ties with Russia, and the EU didn't waste time. Sanctions rolled out, and the bloc set a bold target: completely ditch Russian fossil fuels by 2027. Of course, that left Europe scrambling to fill the energy gap, and fast. The first place they turned? The United States. American liquefied natural gas, LNG, became a lifeline, with US exports to Europe skyrocketing. By 2023, over half of America's LNG exports were heading across the Atlantic, helping Europe dodge a full-blown energy crisis. This shift worked out thanks to America's boosted LNG production and Europe's urgent need to diversify. But there was a catch. The political winds in the US weren't exactly calm. When Donald Trump became president, his America First approach shook up global deals. Tariffs on imports, including those from Europe, became a real possibility, and energy exports weren't off the table. This left EU leaders wondering, what if US gas gets too expensive or unreliable? Facing that uncertainty, Europe kept scouting for backup plans. One country that ticked all the right boxes? Canada. The EU and Canada already had a strong trade relationship, thanks to a 2017 deal that boosted trade between them by 60%. That agreement opened the door for even bigger collaborations, especially in energy. Canada isn't short on resources either. With massive reserves of oil and natural gas, it's more than capable of stepping in as a stable, long-term energy partner for Europe. Canada and the European Union have always gotten along well, sharing common values like respect for international law and a history of smooth diplomatic ties. This makes Canada a solid, trustworthy partner in Europe's eyes. At the same time, Canada's been rethinking how it handles its energy trade, especially after some rocky moments with its biggest customer, the United States. Tensions flared during Donald Trump's presidency when his administration floated the idea of hitting Canadian goods with a 25% tariff and slapping a 10% tax on Canadian oil exports to the US. That was a major wake-up call for Canada, pushing it to look for new markets so it wouldn't be so tied to its southern neighbor. Canada's energy minister, Jonathan Wilkinson, tried to ease the strain by pushing for an energy and critical minerals alliance with the US. Still, the idea of sending more energy to Europe started to look really appealing. Not only would it help Canada spread its economic bets, but it would also help the EU in its hunt for stable, long-term energy sources. This wasn't just talk. Both sides started moving fast to strengthen their trade ties. One key player in all this? The Comprehensive Economic and Trade Agreement, better known as CETA. Since it kicked in, even partially back in 2017, it's been a game changer. Trade between Canada and the EU has skyrocketed. In 2020, goods traded between them were worth 53.3 billion euros. By 2022, that number had shot up to 77 billion euros, a 66% jump. And it's not just big numbers on paper. Canadian goods heading to Europe went from $22.2 billion in 2016 to a record $32.5 billion in 2021, a massive 46.4% boost. On the flip side, Canadian imports from the EU also surged, hitting $67.5 billion in 2021, up 28.4% from pre-CETA days. But there's one opportunity Canada is eyeing closely: liquefied natural gas, LNG. With Europe scrambling to break free from Russian energy, Canada sees a golden opportunity to ship LNG directly across the Atlantic. Prime Minister Justin Trudeau has made it clear, though, Canada isn't rushing in blindly. He wants a solid business case before making big moves in LNG exports. Still, with all these shifting dynamics, Canada has been ramping up efforts to lessen its reliance on the US and spread its energy trade across the globe. Before we continue, I would love to ask you a question. Would you want Canada to join the United States of America as suggested by President Donald Trump in order to avoid tariffs? Or should Donnie let Canada be? Let us know what you think in the comment section below. For decades, Canada has leaned heavily on the United States as its main trading partner, especially when it comes to energy. About 80% of everything Canada sells abroad heads straight to the US. And in 2023 alone, crude oil exports to its southern neighbor raked in a whopping $143 billion, making up 90% of Canada's total crude oil sales. But things got rocky when the US decided to play hardball. In February 2025, President Donald Trump signed off on a fresh round of tariffs targeting Canadian goods, waving the flag of national security as his reason. These new tariffs didn't just sting, they hit Canadian businesses hard, driving up prices and making it tougher for Canadian products to compete in the US market. This left Canada at a crossroads. Instead of sitting back, Canada doubled down on a plan it had been working on since 2018 to expand its trade beyond just the US. The goal? Boost non-US exports by 50% by 2025. And with the finish line in sight, Canada is not only on track, but could even surpass that target. Part of this strategy has been locking in trade deals with countries like Indonesia and Ecuador, but that's just the tip of the iceberg. Canada's also been eyeing energy-hungry markets in Asia, with China and Japan topping the list. The completion of the Trans Mountain Pipeline expansion, TMX, opened the door wide for this. Now, Canadian oil has a faster, more direct route to Asia through the Pacific coast. By October 2024, China was scooping up around 240,000 barrels of Canadian heavy sour crude per day, with an average of 150,000 barrels daily over the previous few months. Why the sudden spike? China's looking to shake up its energy sources, and the quicker shipping times from Canada give it an edge. Japan, on the other hand, is turning into a crucial energy partner for Canada. Experts predict that Japan's thirst for liquefied natural gas, LNG, could jump by over 10%, hitting about 74 million metric tons by 2040, especially if renewable energy projects slow down. Sensing this opportunity, Canadian officials have been deep in talks with Japanese leaders about future LNG deals. Alberta's Minister of Environment and Protected Areas, Rebecca Schultz, has been especially vocal about finding new export markets, highlighting Japan as a major focus, especially with the looming threat of more US tariffs. Meanwhile, Canada's got big dreams of becoming a major player in the LNG game. One standout project is the Energy Saguenay initiative in Quebec, first floated in 2014. With a price tag of $7.2 billion, the plan was to build a massive LNG facility at Port Saguenay that could export 11 million tons of liquefied natural gas every year. What made this project unique? It was designed to run on hydroelectric power, making it one of the first large-scale LNG plants with a smaller carbon footprint. To make it all work, the project also included a 782-kilometer pipeline stretching from northeastern Ontario to the Saguenay terminal, ensuring a steady flow of natural gas for export. Back in July 2021, Quebec's provincial government hit the brakes on the Energy Saguenay project, saying the developers hadn't done enough to prove the plan would actually help reduce global greenhouse gas emissions. That wasn't the end of it, though. By February 2022, the Impact Assessment Agency of Canada weighed in with even tougher feedback. They concluded the project would do more harm than good, boosting carbon emissions, putting the already struggling beluga whale population at greater risk, and negatively affecting Indigenous First Nations communities. With that, the project was officially scrapped. But fast forward a few years, and things started to shift. As trade tensions grew and economic uncertainty loomed, whispers of bringing the project back to life began to surface. The Quebec government hinted that they might give it another shot, but only if the public was on board and the environmental concerns that killed the project the first time were fully addressed. Quebec's Economy and Energy Minister, Christine Fréchette, made it crystal clear. Without public approval, there's no moving forward. Still, even with the door slightly open, environmental issues loom large. One of the biggest sticking points? The beluga whales in the St. Lawrence estuary. These gentle giants have been on the decline for years, with their numbers dropping to about 900 as of 2012, and shrinking by roughly 1% each year. The project's plan to send about 300 LNG tankers through the Saguenay Fjord annually raises serious alarms. More ships mean more noise, a greater risk of collisions, and an even tougher survival battle for the belugas. Then there's the carbon footprint problem. If the Energy Saguenay project went full steam ahead, it could pump out around 50 million tons of CO2 every year for the next 25 years. To put that into perspective, that's about the same as what 15 million cars would emit in a year. That kind of pollution doesn't sit well with Canada's climate goals or the broader Paris Agreement pledges. But Canada's energy story isn't just about one project. For decades, Canada has been the United States' go-to natural gas supplier. In 2002, exports peaked at a whopping 3.78 trillion cubic feet. Even in 2022, Canada was still sending about 2.99 trillion cubic feet of natural gas south of the border, making up 99% of America's natural gas imports. Lately, though, Canada's been rethinking this cozy energy relationship. With geopolitical tensions on the rise and uncertainty swirling, Canada's been pushing to diversify where its energy goes. Instead of sending nearly everything to the US, it's now eyeing markets in Europe and Asia. One major step in that direction is the LNG Canada project in Kitimat, British Columbia. This massive project is nearing the finish line for its first phase, with exports set to kick off by mid-2025. Once running, it'll ship out 1.8 billion cubic feet of natural gas every single day. And if everything goes as planned, a second phase could double that amount, boosting capacity to 3.6 billion cubic feet daily. Shifting natural gas exports away from the US isn't just a win for Canada's diversification goals. It could also shake up the US energy market in some unexpected ways. If Canada starts sending less of its natural gas to the US, it could spell trouble for American energy markets. Think of it like this. If your local grocery store suddenly stopped selling milk, prices would skyrocket, and finding milk elsewhere would get a lot trickier. That's exactly what could happen with natural gas. Prices in the US could jump, especially during cold winters or hot summers when energy demand spikes. Factories and industries that rely on cheap natural gas to keep costs down could see their expenses rise, and guess who'd end up paying more? Everyday consumers. Meanwhile, Canada sees this as a golden opportunity. By branching out and exporting liquefied natural gas, LNG, to Europe and Asia, Canada isn't just reducing its dependency on the US market, it's also tapping into regions hungry for energy. Countries like Japan and South Korea are eager to diversify where they get their oil and gas, and Canada is stepping up to fill that gap. This strategy helps shield Canada's economy from the roller coaster of US trade policies and builds long-term resilience. One major player in this shift is the Trans Mountain Pipeline expansion. This project has massively boosted Canada's capacity to ship crude oil to global markets, particularly across the Pacific. It's like turning a 2-lane road into an 8-lane highway, tripling the pipeline's flow to a whopping 890,000 barrels of oil per day. With this boost, Canadian crude is now flowing to Asian markets in higher volumes, and countries like Japan and South Korea are more than happy to take it. But there's a catch for US refineries. Many American refineries, especially those designed to process heavier crude oil, have long depended on Canadian supplies. With more of that oil now heading to Asia, US refineries may be forced to look elsewhere, likely at higher prices. This could squeeze profit margins and even raise gas prices for American drivers. Then there's the bigger picture, the ripple effect on trade across North America. When the US slapped tariffs on Canadian goods, Canada didn't just sit back. It hit back with its own retaliatory measures. This back and forth has put a serious strain on the United States-Mexico-Canada Agreement, USMCA, which was supposed to make trade easier between the three countries. Industries like automotive manufacturing, where parts cross borders multiple times before a car hits the showroom floor, are especially vulnerable. Tariffs at every crossing point mean costs pile up fast, and that extra cost usually lands on the consumer. And as North American countries duke it out over trade policies, China's been watching and moving in. Seizing the opportunity, China has tightened its grip on critical minerals like gallium and germanium, which are essential for everything from smartphones to fighter jets. By restricting exports of these materials to the US, China is flexing its muscles, hoping to gain leverage in its own trade battles. They've also zeroed in on key American industries like aerospace and defense, slapping them with targeted tariffs to up the pressure. Experts warn that if North America's trade tensions drag on, it might leave doors wide open for China to swoop in and strengthen its global trade position. The longer the disputes last, the more China can fill the gaps left by broken US-Canada-Mexico supply chains. All of this puts a ticking clock on the need for diplomacy. If the trade fights continue unchecked, the fallout could ripple across the region, raising prices, shaking investor confidence, and slowing down economic growth. If you found this video interesting, be sure to hit that like button and don't forget to subscribe.